Hello again, everyone. John Flynn here from Flynn Real Estate, serving Southern Ontario, based out of the Niagara region. Thanks again for tuning in and watching. Before I get into the timeline of Devastation, I'm going to get into the national statistics, real estate statistics for February. And at the end of the video, after that's all said and done, we're going to take a quick look at Oakville and Barrie as per some requests from you viewers. From the Canadian Real Estate Association, Canadian home sales rise in February despite drop in new supply. The highlights for February are national home sales rose 2.3% month over month in February. Actual, not seasonally adjusted, monthly activity came in 40% below February 2022. So we're still seeing these massive decreases in sales year over year from last year. The number of newly listed properties dropped 7.9% month over month. The MLS Home Price Index edged down 1.1% month over month and was down 15.8% year over year. The actual, not seasonally adjusted, national average sale price posted an 18.9% year over year decline in February. Okay, now let's take a look at this data on some charts and try to make some sense of it. Here are the monthly sales. You can see well below the 10-year moving average. They seem to have bottomed out. I keep saying this, I'm like a broken record, but they look like they ticked up in February. So I think they've probably hit the bottom. People still need to buy houses. People are still going to move. So they can only go so low. Looking at the months of inventory for February, the blue lines here on the right, you can see it's actually lower than it was in January. This, of course, would help increase prices. We have low inventory and demand is rising into the spring. So of course you're going to have more competition, and which will put increased pressure or upward pressure on house prices. February's data contained the potential of a more robust market to come. But to repeat the bottom line from last month, we don't know what the 2023 market has in store until the spring, said Jill O'Dill, chair of CREA. While we're not seeing it in the sales or listings data just yet, I would expect homeowners are getting ready for the market and prospective buyers are getting more mortgage pre-approvals. So not really a good prediction there either way. Jill doesn't know what's going on. Just who knows what's going to happen is pretty much what she said. The similarities between 2023 and the recovery of 2019 continued to emerge in February, with sales up, the market tightening, and month-over-month price declines getting smaller, said Sean Cathcart, CREA's senior economist. But the biggest similarity was a sharp drop in seasonally adjusted new listings. Future sellers, many of whom will also be buyers, are likely biding their time until optimum time to list and buy something else. For most, that's in the spring. Will buyers jump off the fence to snap up homes in 2023 once they finally hit the market? They did in 2019. So it looks like Sean has kind of cherry-picked 2019 as the year to compare it to. I actually have some really good comparisons coming up with my timeline, but I think my comparisons are a lot better. But anyways, let's look at the chart here to see what he's comparing to. So when you look at this chart, this is the national average price point in Canada, or straight from CREA. You can see January 2019 there. We were at kind of a low point for prices. He's talking about sales, but again, ultimately, we just want to look at prices and how it's reflected in the price points. So 2019 started off on a low point, and it did significantly increase into the spring. So I don't know if Sean just picked 2019 because it was the last year before the pandemic and kind of a more normal period in real estate. But if you look back, 2017, if you look at this chart again here, 2017 would have also been one of the comparable years where interest rates started to rise. And you can see there in the spring, it jumped right up from January 2017, and it went right back down because they started to raise rates mid-year in 2017. And of course, the economy was starting to slow a little bit then too. So again, not a great comparison in my opinion, but anyway, let's move on. Let's look at the HPI year-over-year percentage change. You can see here on the right, we're down huge, like over 15.8%, I think it was. The biggest month-over-month decline that we can see since 2006 by far. Looking back at 2009 or 2008 to 2009, you can see it. I've highlighted it here in red. It was a nice, smooth, V-shaped recovery, which I think is a prediction from CREA right now. We're going to start getting less monthly declines, and it's kind of going to go back up into positive territory at some point later in the year, maybe. But when you look at the 2018, 2019, it just goes to show you it doesn't always do a nice V-shaped recovery. We had a double dip there. So, yeah, kind of an interesting dynamic. We'll keep an eye on this. I doubt that we're just going to go into recovery mode right now and get into positive territory by the end of the year, especially after what I have to show you next. And lastly, before we get into the exciting stuff, here is the month-over-month increases. We actually had a 8.2% month-over-month increase on the national average price, which is pretty insane. $50,000 on average that houses went up in Canada. We're still down 18.9% from the February peak, which was also our year-over-year losses of 154,000. And you can see that right shoulder is very pronounced now, and I don't expect it to continue up for too much longer. If I was to make a prediction, this would be probably the last rally in housing before we get into a recession. So now we're going to get into a timeline that I created. This was from the 2008 financial crisis. It was in the States, but it did affect us worldwide. Canada got off easy in that time. And there's some very scary similarities to it, especially now hearing about all the banks in trouble and whatnot. So let's take a look at this and see where we're at. So you can see starting from the left in June 2004, the Fed started hiking rates from 1%. Then the yield curve inverted a couple of years later. Mid to late 2006, they stopped hiking and house prices peaked. Foreclosures started rising shortly after that. And in 2007, they had the lowest unemployment since the dot-com bubble, which was 4.4% at that point. Again, in 2007, mid-2007, REITs and hedge funds started getting into trouble. In September 2007, Fed start lowering rates and mid-sized banks start failing. Then we get into the recession. As everyone knows, in 2008, everything falls apart. The Lehman Brothers comes later in the year. Unemployment didn't peak until the year after that in October 2009, and it peaked at 11% in the States. Also, foreclosures peaked in 2009. And in 2011 to early 2012, house prices reached their bottom. So I've gone over this before. It was about 5 years or so from when the house prices peaked till they reached their bottom. But all this stuff obviously happened in between. Now let's look at what's happening now and kind of where we're at and the scary similarities and the many similarities to then. So here's today's timeline. August 2021, inflation rises above 4%. Inflation wasn't really an issue back in 2008. It did creep up a bit, but it wasn't like it was today. February 2022, house prices peak in Canada. March 2022, the Bank of Canada starts hiking from 0.25%. July 2022, yield curve inverts, lowest unemployment in decades. So in Canada, you have to look back 50 to 60 years to reach unemployment that low, and it has risen since this 4.9% in July. October 2022, mortgage arrears rise from all-time lows. They started creeping up just a bit, but they did rise from their all-time lows. Late 2022, REITs, hedge funds in troubles, private mortgage companies started getting in trouble. We started hearing about things like this in the fall. March 2023, Bank of Canada pauses at 4.5%, and mid-sized banks or certain banks that I don't know if they're mid-sized, but they're mid-sized, large, whatever you want to call them, they start to fail. And one thing I just want to quickly mention is if you look at this chart for the federal funds rate, you can see every time they reach the top of their rate hiking process, there's a recession very shortly after or imminently. And you can see those gray vertical lines are actually the recessions, and the circles are the top of the rate hike cycles. So here we are today. We are approximately 3 months before a recession. If you compare this to 2008, everything still has to fall apart. Unemployment still has to peak. Of course, bank sales or foreclosures have to peak, and prices will continue downward. And I've put on here, again, another estimate of good times to buy, and that will start in 2024 at some point and continue for at least a couple of years after that. And I'm not the only one predicting this, whether it's me or other YouTubers or even the mainstream media. Let's look at some headlines just from the last week alone. From March 17th, CTV News, RBC expects mild recession in Canada in middle of 2023. Just a mild one, guys. Trust RBC. You know, they don't want to alarm anybody right now. Canada's Big Six gear up preparations for potential recession. That was from wealthprofessional.ca. Again, that was just last week or so. And this literally just came out today, which is the day before I'm releasing this video. Bank of Canada joins Fed and other central banks in new liquidity measures to ease banking turmoil. Move follows Swiss rescue of Credit Suisse and signals depth of concern over the global financial system. It doesn't sound very promising. Also from Global News this week, Canadian banks are stable, but something is going to break an economy. Experts. I don't know. Something's going to break. I don't know what's going to break, but probably the whole financial system. But yeah, the warning signs are all there. This is like imminent at this point, and the timeline it like adds up like it was like history repeating itself. And lastly, before I leave, let's look at Barrie and Oakville, starting with Barrie. Barrie is down 25.1% from their February peak, or $242,000. They went up 1.3% month over month from January to February, or $10,000, and down 1.7% month over month from February to the balance of March so far, or $12,000. So they've already erased their February gains, which weren't as much as many other places in Ontario. And their cumulative days on market are going lower, just like many other places right now in Canada, into the spring market, right? Now on to Oakville. It's one of these places, lots to gain and lots to lose. They're down 18.1% from March 2022 to the current balance of March right now, about $350,000. They went up 14.8% in 1 month from January to February this year, or $248,000. That's like insane. 1 month, like you can see how volatile Oakville is, and like the whole market in general, right? It's very volatile. And they've already lost 5.8% month over month from February to March so far, or $96,000. So almost 100 grand they've already lost off of what they just gained. And their cumulative days on market just looks like every other place in Canada. They have started to drop going into the spring. We'll see what happens going forward. So I think right now it's pretty fair to say that we're in a looming crisis of some kind, a financial crisis of some kind. The banks are trying to scurry to prop everything up. I don't know what's going to happen going forward, but we're going to keep an eye on it. Thanks for watching, and I'll see you next week.